So when it comes to divergence, there's 4 different kinds of oscillator divergence. 2 are really popular, 1 not so popular, and 1 that people barely know even exists. So what I want to do is show you all 4 of those. Now I'll go through them real quick. We've got regular, hidden, exaggerated, and rolling divergence. Now with those, we would consider them oscillator divergences because we are using an oscillating indicator. In this case, we've got the MACD. This is the MACD histogram. So we've got just the standard MACD 12, 26, and 9. So we've got the MACD histogram only. Don't have the MACD lines. This is the OSMA part of the MACD. And this is oscillator divergence. Now, there is other kinds of divergence that don't use an oscillator. We're not going to cover them right now. We're going to take a look at them later. We've got moving average divergence. We've got trendline divergence. We've got something called visual divergence when the price action itself shows us a divergence without needing any additional indicators. But right now, we're just going to take a look at those 4 different kinds of oscillator divergences. So what I want to do is set up my charts so that I can record this, and during the editing of this video, it'll go nice and smooth, showing those 4 different kinds of divergences. Now, before we get started with the different divergences, I want to explain this moving average. They all have this red 13 EMA on the chart. This is a nice indication that shows us when the divergence actually turns into something that we can trade. Not all divergence will work out into a tradable move. So with this 13 EMA, when we get across, above, or below this moving average, we can now determine that this is a tradable divergence. So with that out of the way, let's look at the first one. It's called regular divergence. This is the one that most traders can identify. And again, we're using the MACD. And with regular divergence, this is a momentum type of divergence. We're looking at the failure of market momentum in the trending direction. So in this case, we've got a market that is moving down. We have a low followed by a lower low. And these yellow trend lines are here to show us, it's just a visual representation of the highs and the lows. So in this case, we see that the yellow trend line is sloping down. It becomes very clear that we have a low followed by a lower low on the price. And if we connect those corresponding lows of the MACD, we've got a low followed by a higher low on the MACD. Now, generally the way this goes is if the price makes a low and then a lower low, the oscillator will do the same thing. It'll follow suit. But when we have divergence, the oscillator and the price are diverging. They're doing different things. They're going in different ways. So we have this low followed by a lower low. The MACD has got a low followed by a higher low. And what that's demonstrating is the lack of downward momentum. The MACD is one of the best momentum indicators there is. And this is a clear example of the failure of that downward momentum. The price looks strong. We even have this really big bearish candle. But when we look behind the scenes and the MACD shows us that, it shows us a market that is getting very weak and is failing in its momentum. So with this kind of divergence, often we can see that the market will reverse. Now again, I have to make it very clear that the market does not always reverse on divergence. Sometimes all we're going to see is a bit of a sideways market while that market is resting. It has run out of steam, it needs to rest, and that rest doesn't always result in a pullback or a change in the market movement or direction. Sometimes it just means the market has to stop for a little while and go sideways. It's very important that that part is understood. So we've got this regular bullish divergence. Now the term bullish when it comes into divergence means because of the divergence, what direction is the market going to go? We've got a downward moving market, and the bullish divergence means the market is likely to go up and become bullish. All right, so the next one is regular bearish divergence. The exact same thing, just in the other direction. We've got a market that makes a high followed by a higher high, and we have an oscillating indicator making a high followed by a lower high. These corresponding highs aren't doing the same thing as the price, they are divergent. So we've got this high followed by a lower high on the MACD, again showing us the failure of that upward momentum. Again, this regular divergence is the one that most traders can easily identify. Now we're going to move on to hidden divergence. It's called hidden divergence because it's less identifiable by most traders, especially new traders. They have a tough time seeing this one. Now, while regular divergence is considered counter trend, hidden divergence is trend following. it supports the movement in the trend direction. So if you've got a market that's moving up, that divergence is going to show underneath that market so that the price can bounce off of that slope and then continue to move up. So we've got this upward moving market, price makes a low followed by a higher low. Let me get my pen tool out. We've got a low followed by a higher low and then continues to move up. But what we're seeing in the histogram is a corresponding initial low followed by a corresponding lower low, and that suggests that the market does want to continue to move up. Another name for hidden divergence is slingshot divergence because of the way it looks. We've got slingshot divergence as the price pulls back, that MACD or that oscillating indicator pulls back, and then it fires that market into that trending direction. Now, I've heard this described in a certain way that I think is really clever. It's not exactly what's going on, but it's a nice way to remember this. I've heard this described as an overextended market. So what we have is the first low, market moves, we get the second low, but that pullback becomes overextended. That's why the second low on the oscillator is lower than that first low. We have a pullback that's a little bit overextended. In this case, it'll be a little bit oversold. Now, again, that's not exactly the case, but it is a nice way to remember this. It is a nice way to make this a little more visible for a trader that finds this difficult to see. We get this market move in the trending direction. We get a pullback. That pullback becomes a little bit more overextended than the initial pullback. And because of that, it wants to correct itself. In doing so, we'll continue in that trending direction. So let's take a look at the bearish version of that. We've got hidden bearish divergence. Again, it's trend following, so it goes across the top of the price so the price can bounce off it and go in the direction of the trend. So we've got a market that is making its moves down. We have a high, moves down, pulls back, and we have the corresponding highs on the MACD doing different things. We've got the price making lower highs, but we've got the MACD making higher highs. Again, you can use this with an RSI or a stochastic or a CCI even, but the important thing is the divergence between these highs. They're doing different things, which is why we consider them divergent. So again, a nice way to think of this is the market is moving down and then making a pullback that overextends that market so that new pullback becomes more overbought than the original pullback. And with that being the case, we know that an overbought market wants to correct itself, so it will continue to move back into that trending direction. So the next one is something called exaggerated divergence. Now, exaggerated divergence is a double top or a double bottom. In this case, we're looking at a double bottom. We're looking at bullish divergence. So with exaggerated bullish divergence, we're looking at a double bottom, but an indicator that shows its double bottom in a much more exaggerated kind of way. So we have this low followed by a move up and then a double bottom. So we make a similar low. Now that low doesn't have to be exactly the same. It could be a little bit higher, it could be a little bit lower, but we have a low that is very similar to that previous low. Now, what's happening with the indicator is that it is making no attempt to even try to get to that previous low. So that second low is really skewed. The difference becomes really exaggerated. So we've got this low followed by a similar low. And on the MACD, we've got a low followed by a much higher low. We have that exaggeration in there. Now, this is not one that comes up a lot. You're not going to see this an awful lot in your trading. But when it does pop up, it becomes a very powerful tool. Now, the next one is to the downside. We're looking at bearish divergence. So we have the price making a high followed by a similar high, and the MACD itself makes this nice tall high, and then the second corresponding high is very shallow. It does not make an effort to try to get to that initial high that the MACD made. Although the price is doing it, the indicator is not even trying to attempt that. We have very little momentum, and as a result, the market will tend to move in the opposite direction. Now we're going to move on to rolling divergence. This is something you may never see. You may never come across this in your trading. Truthfully, this isn't one that's really that important. Almost no trader knows about this. Almost no trader will take advantage of it simply because they don't know about it. But it is a thing, so I do want to show it to you. With rolling bullish divergence, we've got a market that is making a move down and the indicator is starting to move in the opposite direction. Now this MACD indicator is starting to move up, and even though there are some lows being formed in the price, those lows are not reflected in the indicator. The indicator smooths that all out, and it in effect becomes a rolling move. It doesn't reflect the bounce in the price the same way, and it just rolls on to the other side. And when we get that close above that 13 EMA, this indicator has actually switched sides, and that rolling divergence has changed the direction of the market. On the downside, we've got rolling bearish divergence. We've got the market moving up. We have a little bit of a pullback in here, so we could minimize this a little bit, but we've got this market move up. The indicator doesn't reflect the movement of the market quite in the same way, and it rolls over it. It continues to shrink and move to the downside, and we get that short opportunity right in here. Rolling divergence is often very smooth, and we don't have the same reflection of the highs and the lows that we have generally speaking. When you take a look at the market movement, we've got a high, the MACD makes a high. You've got a low, the MACD makes a low. But in rolling divergence, that reflection isn't so clear anymore. And at the end here, we were looking at this chart. This is something called triple divergence. What we have is a high followed by a higher high. And what you'll see is a high followed by a lower high on this MACD. This is a nice example of how the divergence doesn't play out. And if I connect those highs, let's do this the right way. There we go. If I connect those highs on the MACD, we can see that we do get a bit of a pullback. We don't, however, get a move past that 13 EMA. And because we don't get a move past that 13 EMA, we can't really validate this divergence. Now, what does happen is the price bounces, it continues to move in that trending direction, but that MACD continues to make a lower high. Now we have three highs, 1, 2, 3, 1, 2, 3. This is considered triple divergence. Triple divergence is usually very powerful. It usually will result in a market move in the opposite direction. And we can see that market move happens right here as that candle closes on the downside of that 13 EMA, and then the price just drops a little bit. Now, again, this isn't always going to be a home run kind of trade. It is showing us that there is weakness in that upward market momentum. And because of that weakness, it needs to reset itself. It needs to relax. It needs to rest. And the way the market does that is by either moving sideways or making a pullback. Now, that pullback can sometimes lead into an actual full-on trend reversal, but oftentimes it's just a pullback. But the divergence shows us when that pullback is most likely to happen. All right, so those are the four different kinds of divergences. The regular divergence is the one most commonly used. The hidden divergence is there, and it's a great tool if you can see it. And the other divergences, the exaggerated one and the rolling divergence, are probably something that you'll never use in your trading. But because they are a thing, I wanted to be sure that you are aware of them.